Traders Corner is brought to you by IG.
You're watching Traders Corner. I'm Stephen Gagnon, and as usual with me in studio is founder and editor of Traders Corner, Garth McKenzie. Garth, thank you for coming in. And Julietta taking a well-deserved break this week, but she had been discussing the markets with you in the previous few weeks where there was a holding pattern where the S&P 500 was stuck. It broke that holding pattern towards the middle of last week. So are we looking for a new direction now?
Yeah, hi Stephen, it's good to be back. You're right, we've been monitoring the S&P 500. We always generally have a look at that as our first chart of the day, just to sketch the bigger picture from a background perspective. The US markets are always very important to monitor because they do tend to create a little bit of a theme or somewhat of a direction for other markets to some extent. So we watch the S&P 500 very carefully, and the chart of it is up on the screen at the moment. And what I've been going on about for weeks on end is the fact that the S&P 500 has been narrowing into the apex of this triangular type of structure. And I said to Julietta for the last 2 weeks that we are going to see a breakout one way or the other. It's coming. It might pop to the upside, it might break to the downside. But I also made the point last week that the longer it sort of dribbles into the end of this apex, as it did in this case, the more propensity it is to just sort of fizzle out the bottom of that pattern. And that's what we've seen now over the last week or so. You can see that this upward trend that goes back to the June low, that was Brexit over there at the June low. The S&P 500 had been climbing up that upward trend, and now it's broken quite convincingly below that upward trend. And we've got a pattern of lower highs that's been in place now for around about 2 months on the S&P 500. The trading action here seems to have established itself below the 50-day moving average. That's that light blue line over there, which you can see I'm pointing out now. And again, you can see the trading action being quite well established below that 50-day moving average. And the 50-day moving average has taken on a slightly downward slope now. And I always look at that as a medium-term trend indicator. If the 50-day moving average is pointing up, then you can be reasonably confident that your medium-term momentum is upwards. If your 50-day moving average starts to turn to the downside, then that begins to tell you that your medium-term momentum is weak. And that's what we're starting to see here now. So in terms of levels that are significant for the S&P 500 at this stage, we've got 2120 at the bottom here. You can see that highlighted by that dotted line. That was the low in September. That low was again tested again last week, and that was a previous high back in June of this year. So that's a critical level. And then to the upside, around about 2180, 2170, that sort of zone is quite important as a resistance area. Now, for me, what's interesting here is the fact that this S&P 500 has been making lower highs since the middle of August, really, and we've been testing this 2120 a number of times since then. I do begin to think maybe the potential for a break of that 2120 level increases at some point. And if we do see that, then chances are we could come down here to around about 2080 and maybe even visit the 200-day moving average, which is that red line over there. So I think for now, let's monitor what happens at 2120, but certainly not as bullish a looking chart as what it was, say, 2 months ago. At this stage, it's looking a bit precarious, and it looks like the momentum is starting to roll over a bit.
And if you compare that with the top 40 charts, it also broke lower Wednesday, Thursday last week, so really, I suppose, mirroring what was happening on the S&P 500.
Yes, to some extent, that's right. Obviously, our market very influenced by the value of the rand, so a stronger rand makes our market go lower typically, and a weaker rand makes our market go higher. And of course, with all the political noise at the moment, we're seeing a lot of fluctuations within the currency. Yeah. So over here on the top 40, we've got this 45,000 lateral support level, which has been in place for most of this year. It goes back to February. And then below that, I've got that dotted line over there. That is the level of 44,000. So we seem to have been breaking below 45,000 quite frequently of late, and now this 44,000 area seems to be propping us up as a bit of support. But for me, what's still interesting here is to note that we've got lower highs and lower lows that have been happening over the last 3 months here. Our 50-day moving average, which is that red line, is beginning to tend ever closer towards the 200-day moving average, and it looks like it's just a matter of time before these two moving averages actually cross over. And not that I pay a huge amount of attention to that, but generally speaking, when you get a 50-day moving average crossing down below a 200-day moving average, that is an indication of weak momentum from a medium-term perspective, and it can result in further weakness. So my gut sense is that we do still run the risk of having another push to the downside at some stage, but maybe not right now. And the one thing I've got sort of stacking up against that is the fact that our stochastic oscillator, which is that squiggly line along the top there, is making positive divergence at the moment. So that's where the stochastic's making a higher low than than on the previous pullback, and yet the price is making a lower low. So that's positive divergence, and it can sometimes preempt a bit of a move to the upside. So a mixed picture, but overall, I don't know, if I glance at that chart, I still think we need to be careful. I still worry that we're going to have a spike to the downside at some stage.
If you do break below 44,000, what would the next level be you'd be looking at?
Well, from a strict technical perspective, that then opens 42,000, which is you can't see it properly here, but back in February of this year, the tails to the downside of those candles, they came in at about 42,000, and that would be my first sort of area of potential target. There's even potential that it goes to 41,500. But certainly I think 42,500 would be a feasible target if we start breaking below 44,000.
You are the protected whichever way it goes, aren't you, Garth? Because you had an option structure and then you took a 50% hedge against that option structure. Yes. So whichever way it goes, you are going to have a level of protection.
Yeah, that's correct. Where we sit at the moment, we're in the luxurious position that if the market goes up or down, we're going to make some money out of our option structure that we've got on. This is a structure that runs out to the December futures closeout. And I've just got the illustration of the payoff profile on the right-hand side of this graph over here. It's a put spread option structure, which gives us participation to the downside below 46,500 on the index. Now, obviously, we've been trading below that level for a while now, so that option structure is in the money. It affords me, therefore, the opportunity to buy against it if I do feel that we've got the potential to stage a bit of a bounce. Last week, I did do that. I went with a 50% long hedge against the option structure. And the reason for doing that is it gives us what I like to call a V-shaped payoff profile. And you can see the V sort of indicated on the right-hand side there. From 46,500, if the market goes up, we'll make money. If the market goes down, we'll make money. And that's, for me, a comfortable position to be in at the moment. Because it's a trendless market. Let's face it, there's no particular direction here. So by putting that 50% hedge on last week, it allowed me to be short and long, effectively, which is quite a nice place to be. And whether the market goes up or down from here, we stand to make some money out of that option structure.
And now, despite the uncertainty in the markets at the moment, you have decided to buy Naspers, and of course Naspers is the biggest component of the top 40, so largely kind of drives the direction of the top 40. Why have you decided to buy Naspers now?
Yes, that's right. So on the 4th of October on this show, I covered the biggest 4 shares on the top 40, and obviously Naspers is the biggest. It holds about a 20% weighting in the top 40 index, so it's a heavyweight stock. And what I'd said at that stage was that the Naspers has been trading upwards in this nice, neat channel throughout the year. You can see that quite clearly illustrated over there. And on the 4th of October, I said this share price was looking as if it was vulnerable to breaking below its 50-day moving average, which is that red line over there. And I said that if it breaks below the 50-day moving average, then chances are it's going to go down, test the bottom of that broader channel, and then I think that would present us with a buying opportunity. And if it did that, I would most likely look to buy a couple against the fact that we've got that options protection in the background, which serves as insurance for us anyway. So you can see the 2,200 Rand support level, which is the bottom of the channel over there. I mentioned before that it looked as if the price was going to go there, and it's gone there, and it's moved up off of that level now. So I'm going to stick to what I said, and that was that I would probably look to buy it if it pulled back into this area. So I'm doing that. Also, what gets my attention here is the fact that we've got positive divergence on the stochastic oscillator. And again, that is where your stochastic oscillator makes a higher low on this leg down than what it did on the previous leg down, and yet the price of the share is making a lower low. So it's often an early warning that maybe your selling pressure is beginning to wane. And if you look back, there were previous examples of it here in June as well. where there was some positive divergence there, and that did preempt a little bit of a rally in the share price. So based on that, I've decided to go long of Naspers. I didn't get it as low as 2,200 when it was there last week. I've gone in today at 2,272 Rand, and I'm going to set my stop loss below the lowest point of that spike to the downside last week. So below 2,190, I'll stop this trade out. And then I would ultimately look for it to break this downtrend. You can see that downtrend illustrated there with the thin blue line.
Yeah.
That goes back to the beginning of September, and that basically demarcates this whole corrective process that we've had over the last 6 weeks or so. Something we were, quite honestly, we were expecting. We were calling for this correction all along. If that share price begins to break out above that trend line now, I think that would be quite a bullish setup. So then I'd look for it to move higher. I don't have a specific target in mind here. The idea being that I know I've got that options protection in the background, which is like insurance. So my thinking all along was have that insurance in place, but buy some strong stocks against the options when the opportunities present themselves. And Naspers, by and large, is one of the strongest stocks. It's just spent the last 6 weeks consolidating. But overall, I mean, you can't deny the fact that that is a strong stock. It's trending upwards. Nice pattern of higher lows and higher highs. So I think it's good to have a go at it here.
Yeah, and the risk per share, obviously, the difference between the buy and the stop loss, so that's 82.93 per share, Garth.
Yes, that's right. Well, let's have a quick look at all the details here. So just to flesh it all out, I'm going long at 2,272 Rand and 93 cents. My stop loss, 2,190. So that therefore means that my risk per share is 82 Rand 93 per share. So it's a very wide stop loss. Ideally, I would prefer something tighter than that, but in this case, I've made it very wide. And that also means that we have to take a smaller position because the fact that the stop loss is so wide. I'm risking 4,485 Rand, which equates to 1.5% of our capital. We've got 299,000 Rand in capital at the moment. So 1.5% of that translates back to 4,485 Rand. So to calculate my position size, I take the total capital risk of 4,485 Rand, and I divide that by the risk per share, which is 82 Rand 93. That gives me a number of 54 shares. So to round it down, I've done 50 CFDs for our portfolio. That means that the exposure that we've got here, 50 CFDs multiplied by the share price, is 113,000 Rand worth of exposure that we've taken to Naspers over here. And then lastly, the target, well, as I said, I don't have a specific target in mind. If the share price begins to break that near-term downtrend that I spoke about, then I think we can potentially see it go back to the prior high. But my plan here is really to give it a bit of room to try and run. And I will monitor it on a week-by-week basis to see whether it's time to take profits at some point. But I know that we've got a stop loss here, and I also know that I've got an option structure, which gives me insurance in the background as well.
Yeah. And talking about targets, how's your charity portfolio looking at the moment, Garth?
It's looking good, actually. We're sitting at a new high for the year to date. We've got 299,000 Rand in the kitty, so almost on that magical 300,000 Rand number. That means we're up 19.75% for the year to date. And we've still got, about another 2 months to run out with the show before we need to hand the money over to charity. Those are the positions we've got in the portfolio. You can see our December option structure on the top 40 there. We've got some All Me, that's effectively a mini top 40 contract. I've got 5 contracts long there, and that is a 50% hedge against my option structure that I mentioned before.
Yeah.
And then lastly, you can see the Naspers trade that we've put on this week, where we long of 50 CFDs at 2,272 Rand. So all looking good at this stage, and we're obviously looking to try and improve that profitability figure as the year draws to a close.
Hopefully we get that Santa Claus rally towards the end of the year, Garth. Trading courses coming up?
Yes, we've got courses in November. So I'm doing a high probability trading course in Johannesburg on the 19th of November, and then also in Cape Town on the 26th of November. And my colleague Andrew Todd runs a top 40 trading course, and he's doing that in Johannesburg on the 12th of November. So anyone watching this that would like to attend any of these courses, please email me, garth@traderscorner.co.za, and I'll send you all the details.
Okay, and of course, Garth at Traders Corner, if you want to get onto that mailing list. Garth, that's where we have to leave it. Thank you very much.
Super, thanks.
And that's Traders Corner for this week. Thanks again to Garth McKenzie. He's founder and editor of Traders Corner.
Traders Corner is brought to you by IG.